All right, so let's get started. Welcome everyone to our session, Where's the Capital for Climate? My name is Michael Wang. I'm an anchor with China Global Television Network, or CGTN. First of all, thank you for joining us during lunchtime. I think this really shows how dedicated you are to this topic, joining us here at lunchtime. So when I first heard the name of this session, it was quite interesting to me, right? Where is the capital for climate? And it seemed to have suggested that there is limited capital for climate projects around the world. But for us who are following maybe this topic, we often hear about those numbers, right? Record clean energy investment in 2024 to the tune of north of $2 trillion. We hear that we are now investing more in clean energy relative to fossil fuels. In fact, twice as much clean energy relative to fossil fuels. We heard that yesterday at the forum as well, at a great panel. It's called Checking In on the Energy Transition. So if you guys missed that conversation, I highly recommend listening to that one as well. Extremely informative. So the capital is there. It's just that 3/4 of that investment, 3/4 of that capital is concentrated right here in China, plus the advanced economies. Africa, for example, unfortunately only gets about 2% of clean energy investment, despite having 20% of the global population. So our goal for this conversation is to talk about how do we better mobilize and scale up capital for climate finance, especially in emerging and developing economies. And we've got an absolutely fantastic panel to talk about all of that, because we have perspectives from a bank, from an investor perspective, from climate tech, and of course, from a seasoned climate negotiator as well. So let me quickly introduce our panelists. We have a veteran of the Paris Agreement and the Kyoto Protocol negotiations, His Excellency Liu Zhenmin, Special Envoy for Climate Change of the world's largest renewable energy investor, China. This one country alone accounts for over 40% of the global renewable energy capacity. Sitting next to him is Ms. Nonkululeko Nyembezi, Chair of Standard Bank, Africa's largest lender right now, lending and directing nearly 6 times compared to renewables, 6 times towards renewables compared to fossil fuels. That is quite an interesting and amazing statistic, and hopefully we can talk about that a little bit more down the road. And I think it really shows that a bank from an emerging market economy can really scale up and accelerate sustainable finance in a region where it's needed the most. Next to Nonkululeko, after shepherding COP28, I would say, His Excellency Majid Al Suwaidi is now CEO of Alterra. This is the world's largest private climate investment fund, $30 billion committed by the UAE, hoping to scale that up to $250 billion by the year 2030. And then next to His Excellency Al Suwaidi is Himanshu Gupta, who is co-founder and CEO of ClimateAi, which to my understanding, and correct me if I'm wrong, Himanshu, you're trying to transform climate risk into something more akin to credit and commodity risk, where you're using your AI models to better quantify climate risk for businesses, allowing them to make better decisions in terms of pricing climate risk and hedging against climate risk. Am I somewhere in the ballpark?
Almost there.
Almost there, okay. So you explain more about what ClimateAi is afterwards. Previously, before ClimateAi, Himanshu was also the lead emissions modeler for the Indian government during the Paris Agreement talks, all while you were in your 20s?
I don't remember the age. But
you don't know the age, but somewhere around that age range, which is very impressive. All right, so let's get the conversation started. And I want to start with a framing question for all of our panelists, just to get a temperature check. And that's right now we see a confluence of forces, especially in 2024. We have geopolitical tensions, right? Trade tensions are part of that. We have a lot of mind share devoted right now to artificial intelligence, a lot of attention paid towards AI. We see a backlash against ESG in certain economies around the world. We see large banks from certain economies pulling out of the Net Zero Banking Alliance. So as it stands right now, I just want to get a temperature check in terms of what's the mood like for climate finance, and how about we just go down the line. Special Envoy Liu, let me start with you.
Thank you, Michael. I think it's a great honor to join fellow panelists for this discussion. I think you have mentioned since the beginning of the year, the people throughout the world started to worry that whether this energy transition process started from Dubai, and these climate finance agreements reached in Baku last November could be continued to be implemented or not. I think you rightly mentioned that the number of things happened since the beginning of the year. There'd be announcement by President Trump that the U.S. will for the second time withdraw from the Paris Agreement. Then the launch of the tariff war and the shift of the global investment, especially for developed country parties, to AI. And their continued support for some of the regional conflicts, like Ukrainian crisis. I think, of course, this escalation of the Middle East conflict also raised another concern. The people are worried about whether the world are prepared to continue to support climate financing, especially support energy transition in the developing countries. That's a worry. And I'm one of those who are worried about. For the forthcoming COP30, there is a mandate to prepare a roadmap for, so after the agreement on 300 billion agreed for the so-called NCQG, whether the COP30 could agree on the so-called roadmap for the 1.3 trillion climate financing for the next 5 years. Yeah. That's a very, very serious challenge. I think that's why we're encouraging all the parties, all the stakeholders to be more creative and innovative. We should not wait. That's why we are waiting for more innovative ideas for that.
I mean, I think it's absolutely important to take a look in terms of how geopolitics is affecting the global energy transition. We should definitely be laser focused on that. I forgot to mention, if you're joining our conversation online or on social media, feel free to join us via the hashtag AMNC25 to share your thoughts as well. And I'm going to leave around 15 to 20 minutes for audience Q&A afterwards, so get your questions ready. Ms. Nyembezi, let me get your thoughts on this.
Thank you, Michael. So let me start by not dissing my moderator, but to just point out that very often progress is measured by things not in the press, right? Because the press has recency and it is also very over-indexed on things going wrong, because as human beings, that's what we want to consume. So the fact that we're not reading about climate financing doesn't mean it's not happening. It means actually probably it's happening about how it should be, because if it wasn't, you wouldn't read about it in the press. So let me start there. So from a banking perspective, we sit at an interesting nexus between providers on the one hand, because banks would never actually fund an infrastructure project on their own. They crowd in various actors and layer that finance. And the users on the other hand. And I would say from a Standard Bank perspective, we have not seen a lack of appetite for climate financing. There was always a scarcity of capital for infrastructure, broadly defined, and it continues to be there to some degree. So the emphatic answer from an African perspective is we have not seen a move away from climate financing to the extent that one would suspect from all of the press on coming away from net zero type alliances. So that would be the first thing I would put on the table. The second thing is, from an African perspective, because the problem and the challenge we are addressing is somewhat different, it is much more of energy security in the first instance. It is also energy affordability. So you've got access issues, you've got affordability issues, you've got equity issues in that continent. So we work very much at the intersection of energy availability, making that available to more people, and addressing climate issues. I cannot think of a better time than today to do that. Why? Because China has made renewable energy cheaper than anything else you can put on the ground. And we happen to be in a continent that is fortunate in being endowed with rich natural resources for renewable energy. So we actually feel no kind of pull away. In fact, we get a pull towards renewable energy in a big way, particularly in South Africa, which had, at this time that the renewable energy program began, it had literally 95% of our power generated from coal. So it was quite different from the rest of the African continent, which uses hydropower, wind, etc. We use coal in the main, and so we've been a subject of much interest and debate in the COPs, for example, and actually a lot of assistance from the international community for that reason. So we do think that it's just starting. In South Africa today, we've had, I think, roughly a 30% market share in renewable energy financing in the way that it's come. The third point I want to put on the table and can expand on later is we've also come to this point at a time when governments have become much, much more open to changing regulatory regimes in order to allow this to happen. So if you just think about the past, if maybe you don't think about the past because you don't come from South Africa, but in South Africa, we actually had it in law that nobody else could generate power except this one utility that was state-owned. But then the country got to hit a brick wall, and suddenly the country was running out of electricity and becoming the butt of jokes about load shedding all over the world. The government gets to the cliff like that, and suddenly it becomes very interesting to bring in the private sector in a much, much more direct and meaningful way, which is what happened in South Africa. But to do that, the government had to be prepared to change the laws, which they did, so that today we have much better private-public engagement on generating power. Having learned that lesson, and we think that by 2030, 2035, renewable power from private generation will constitute more than 40% of electricity that is generated in that country from a standing start hardly 15 years ago. So a lot can be achieved, not in China-type time, but in the time that suits a developing market like ours. So those three things together would tell you that not only is there not a shortage of interest and appetite in funding renewable energy, but in fact, that is accelerating.
Sounds like the opportunity, I guess, for clean energy investment in Africa is absolutely massive. And you were telling me earlier that there are still around 600 million people in Africa that are not energy secure. I mean, that sounds like a travesty, but that's an opportunity as well when it comes to private investment.
And what is great about this is you're now crowding in technology from everywhere. So you're no longer going to wait for a centralized grid in order to service remote locations. You can now do distributed grids. And that's exactly what you will find if you go to Tanzania today. And so I think we're going to be able to bridge energy insecurity in a much shorter time in today's world than we could have done certainly 20, 30 years ago when it all came from a centralized power plant. So, the world is fragmented, it's difficult, it's challenging in one sense, but in another sense, the world is far richer in technology to address real problems, because essentially in our world, there has to be an economic growth angle to everything that we do. Yeah. So it's not difficult to fund a renewable power project if, in fact, the overall societal impact is that you have better human flourishing.
Yeah, there's certainly a business case, a development case as well. So, Excellency Al Suwaidi, the interest from the banking sector clearly still there, very strong when it comes to climate finance. I would assume it's the same story when it comes to the investment industry.
Yeah, Michael, thank you for having me. It's a pleasure to be here with such an esteemed panel. I think that what's changed is how we talk about climate finance. And I think that really started at COP28, where we spent a lot of time, and we've discussed this, thinking about, well, what were the things that meant, if you remember, we were off track for achieving our Paris goals, and what were the things that we could do to bring ourselves to be back on track. And what we realized at COP28 was that we really needed to engage the private sector in a really meaningful way, that we couldn't continue in business as usual. And so what I see when I engage with partners in the financial sector, the partners that we work with, is that the way we think about climate, the way we think about it as an investment opportunity has changed and become more practical and more pragmatic. And the way we think about energy has become more practical and pragmatic. And that, I think, is for all of our benefit. We know that energy demand is going to double by 2050. We know that we need to make sure that that's as clean an energy mix as possible. And all of the investment partners that we work with all have very long-term plans and investments when it comes particularly clean energy, but then more broadly in the climate space. We at Alterra were a vehicle that was created at COP28 for exactly this purpose, how to think differently about how to mobilize capital. We saw, as we traveled around the world and asked people about what were the challenges, was that time and time again, they were saying that climate finance was the issue. But when we looked at it, we would hear from project developers that, oh, we have a great pipeline of projects, but we don't have any capital. And we would hear from finance folks, oh, we've got loads of money, but there's no projects to invest in. So there's clearly a mismatch between these two groups of people. And so we said, well, what do we need to do to change the dynamic? One, we need to make sure that when we talk about climate, we're talking in a positive way, that this is an opportunity. This is a chance to invest in the future economy that we want to have. So much of the climate conversation in the past has been about what we're taking away from people rather than what we're giving them. And I think that that's what's great about the folks that you see on the panel today, is they're all people thinking about what are we going to give people. We, as representatives of the Global South, know that as economies grow, as people develop, they want to have a better life. And we need to be thinking about how are we providing them the power to light their homes, to cook, to educate their kids. And so it's really a positive discussion. And so if you see the growth of population, you see the energy demand, and now you add that layer of AI over the top of it, we know that this is just an economic case. And we created Alterra to bridge between what was done by concessional capital in the past to bridge to bringing in the private sector. We're a 30 billion fund that has 25 billion to invest globally, and then 5 billion that's dedicated for the Global South, and we can do that in very innovative ways. And then we partnered with 3 large asset managers in Brookfield, TPG, and BlackRock, who we knew would be able to manage the scale of the capital that we have. But we have relationships with all the large money managers. We're very fortunate in the position where we are in the UAE that we have access to a very big ecosystem. And when I talk to all of them today, all of them are investing the same way behind these trends, because these are trends that they see make economic sense and that they want to put money behind.
Excuse me. Himanshu, maybe you can follow up on Excellence Al Suwaidi's comment. He mentioned a change in narrative, perhaps, and you were mentioning to me earlier as well in terms of how we can change the narrative on climate change, and that potentially can draw in more capital, having that more positive story. Add to that, and then from a climate tech perspective, how challenging is it to get funding right now? Let's try and diagnose the problem there, because you started ClimateAi in 2017. Maybe the criteria, the conditions have changed since then. So how difficult is it to get climate funding right now as a climate tech entrepreneur? And how do we change the narrative on this to make it not so long-term, it seems like? Because we have these goals, right? 2050, 2060, 2070, maybe. That seems like a really far away time for a lot of people. And intuitively, it might be really hard to grasp what a 2 degrees centigrade increase in temperature means for all of us.
Thanks, Michael, and thanks for having me here in the presence of some of the OGs in climate policy. I was a former climate policy maker myself. And I want to start with a caveat that a few weeks ago I became a dad, and I'm severely sleep deprived. and with jet lag. So if I go on a tangent, I have a baby excuse.
Can we give a round of applause for being a new dad first? Congratulations.
So as you said, like, I want to start the narrative, I'm focusing a bit more on the changing the narrative of climate finance. And in order to change that narrative, it's important to also talk about some of the myths that exist, even in people in the ecosystem that believes in climate change. One is, of course, it's said that it's a developing country problem. It's no longer just a developing country problem. If you look at the recent report from Bloomberg New Economy, it has quantified that from April 2024 to April 2025, US economy suffered a hit of $955 billion. We account for the hurricanes and the wildfires and so on and so forth. So that's 3 to 5% of US GDP. And to me, this was interesting that there was so much, of course, panic around tariffs being announced. Even the IMF and the most pessimistic estimate on the impact of tariff on the US economy was 3%. So US consumers are already starting to pay climate tariff. Number one. So it's no longer just a developing country problem, it's very much a developed country problem as well. Number two is, since I've been involved in climate policy, I've seen that most of the discussions are around 2050, as if 2050 or the 2-degree scenario is a magic number, right? We have already crossed 1.5 degrees, and we talk in terms of averages. Average temperature rise by 2050, or average temperature rise by 2100. I think we need to change the narrative from averages to volatility. The moment we change the narrative from average to volatility, suddenly businesses start paying attention. And we work with more than 53 of the top 200 food and agriculture and beverage companies globally. And this has been a real comment from someone, a CEO of a big tomato processor, that since he founded the tomato processing company in the last 25 years, the worst 3 years in the last 25 years have been the last 3 years in terms of production losses in tomatoes. And it's a big European tomato processor, right? So the moment we change the narrative from averages to volatility, suddenly businesses start to take notice. And as His Excellency said, like, you can start framing the business case for acting on these risks. And the moment businesses can make a case of ROI versus cost, then suddenly there's a case for making investments and seeing this as an opportunity. And I can talk more specifically about the case studies on opportunities as well. And the third is like, I remember my days of emission modeling when we prepared the emission net zero pathway for India by 2017. The biggest lever that we identified for achieving net zero pathway for India, take a guess, wasn't renewables.
I mean, I know the answer. I would love for the audience or our panelists to take a guess. But how about you give us the answer?
Resource efficiency, right? So 60 to 65% of emission reduction for that net zero pathway could be achieved by resource efficiency, which includes how we build our cities, how we build our public transport. Is it connected? Is it electrified? And is it connected, electrified, clean, and so on and so forth? And then from after resource efficiency, we said, like, whatever emissions we cannot reduce, now we have to think about renewables and hydrogen and storage and so on and so forth. So much of the discussion, however, is about renewables on the supply side, very little on the demand side. And even if you look at the US numbers of emission reduction from 2005 to 2025, and this data is available on US EPA website, EIA website, right? Close to 45 to 50% of emission reduction from 2005 to 2025 has come from energy efficiency measures in buildings and so on and so forth. 25% have come from renewables, and 20% has come from fuel switching of coal and so on and so forth, right? So why is resource efficiency not an investable asset as renewables are? Can we shift the discussions from not shift, like also include energy efficiency into the discussions of climate finance, which is the cheapest, the fastest, and a high ROI with low payback period asset class. And also you talked about the climate tech. In Silicon Valley, over the last 20 years, right, there have been two climate tech cycles, boom and bust, boom and probably another bust in the next year or so. Two of the biggest success stories in climate tech have been these energy efficiency startups.
You wouldn't know that from reading the news because we focus so much on mitigation and technology. We're not talking enough about energy efficiency and maybe adaptation. So I'm assuming there's a lot more climate finance going towards mitigation rather than adaptation. Finish your thought, Himanshu.
No, exactly. So, I mean, those two energy efficiency startups generate a lot of returns for the investors, which included, of course, the pension funds as well as the VC asset class. But again, most of the funding goes to mitigation. And much to your point, now thinking about adaptation, and that's a different beast altogether, right? In fact, I would make a case that can we really be dependent on developed countries, given the situation in the US I just described, and $955 billion of hit, and the White House pulling back funding on recovery and disaster recovery and preparedness. So even the states in the US are scrambling to get financing for climate disaster recovery. So can we really expect some of these rich countries to put money in the loss and damage fund now? We can be optimistic about it, but would it be practical to do so?
Well, you pretty much asked my question that I wanted to ask a Special Envoy Liu, but I'm going to get to that question for the Special Envoy in just a second. Ms. Nyembezi, let me come to you. Of course, what Himanshu said is very correct, right? Climate change knows no boundaries. There is no distinction between developed and developing. But let me focus a little bit more on getting climate finance to developing countries, because I feel like by this point, we already know the risks of investing in developing countries for climate projects. We know what these risks are. We know how to mitigate these risks. There are best practice guidelines out there, and yet climate investment in developing and emerging markets still about 15 to 20% of the global capital. Why is that? What more can we do on that front?
Well, I think we've been studying the territory and trying to find answers to some of the really big bottlenecks, right? So what could be a big bottleneck? Typically, these projects are done through PPPs. And so where government and business meet, there's a lot of friction, and working through that has taken quite heroic efforts. And it's small things, but small things that are quite messy. So, for example, there is no way to get data. The biggest problem that governments face around the continent on infrastructure generally, but climate infrastructure, is to make available like quality, comprehensive, rigorous data on the projects that they want to launch, and that you could think of as an investable project. We want to fund at the point where we can now see the economic feasibility of a project, and yet governments don't have the expertise to take what is a need, whether in the economic infrastructure or societal, and do enough work to make it investable. And it took a long time for any of the suite of funders that are involved in this area to fasten on, we need capital to prepare projects. So if you did nothing else as a government but make sure that you have a special purpose expert project team that just does that, I think you would see a much quicker pace of change. Let me give you an example. So South Africa has done renewable energy investment as a program. So when it started about 15 years ago, thereabouts, it has continued through time. And so what they did was put together a project office with an independent management to look at all of this. Now, contrast that to what typically happens, which is they do a project in 2018, maybe you don't see another project until 2023. So that very sporadic manner in which projects have been done is not conducive to doing things at scale and mobilizing capital. So that's one thing. So the project expertise, number of investable projects, people with the capacity and expertise to prepare projects to feasibility stage and investability is one side. The other side is, even as an infrastructure project is progressing, it's very hard to track progress. There's no way you can go to see, they said they will be here at this time, are they there, are they meeting the hurdles they said they would meet, until the very end when they haven't, right? Over budget, over time, et cetera, et cetera. So just to have dashboards around where investors can go have a look at how governments are actually progressing according to the metrics that were set, to give credibility and confidence next time round that that particular government wants to put a project on the table. The third one is something that he's alluded to a little bit, the gap between the one side and the other, and how you make sure that the people with interest to fund have visibility on the projects that are there. Our role in that is to create products. So we can then have sustainability or sustainable financing products, green bonds. It helps if there's a capital market, of course, because then the information is far more visible. But essentially, there needs to be somewhere a repository of what are the programs, instruments, projects that people can actually invest into. Given the fact that if you have an equity investor, for example, and equity in the US and in the UK and South Africa is more or less the same. You use the same analysis tools, et cetera, et cetera. Infrastructure is not like that. It's a bespoke thing every single time, which means every time you have to build a new team and you have to resource a new set of skills in order to do that. To start to do this in a more programmatic way over time means you're building capacity and skills all over the value chain in order for this to be investable. And the last one I would put from a banking perspective is that the financial sector finds the capital requirements from a prudential perspective quite punitive for infrastructure as an asset class, which it isn't yet, but it should be. But essentially the weight of infrastructure in your capital stack is pretty high. And that has been pointed out repeatedly, and it has not been changed. And as long as that is the case, banks and particularly insurers are going to be very mindful of putting in capital behind infrastructure and climate infrastructure in particular. Because of course, the risks, the tail risks in climate are poorly understood. We understand them better today than we did 10 years ago. But if you're thinking about 2050, we don't have those modeling tools to actually model risk and price it appropriately to price that product. So a lot of this, we kind of flying the plane and we're fixing it at the same time, but it's not, I think the supply side has been too much of a fixation. The tooling that is required to free up that capital and deploy it in actual projects is now what is in front of us. And I think we're getting there, but more slowly than people want to see progress.
Fascinating. Special Envoy Liu, let me come to you. We just heard from Ms. Nyembezi in terms of some of the foundational challenges when it comes to driving climate finance towards developing economies. Let me get your perspective on this. From China's perspective, what are the bottlenecks you see in terms of driving more climate finance to emerging markets?
Thank you, Michael. I think to be actually, against backdrop of the current crisis, we need to be more innovative to say that on the one hand, we need to continue to urge the developed country parties providing funding, because I think that, as a colleague mentioned, because for most of developing countries, especially LDC countries, they're expecting that the funding for adaptation should come from the public funding. They don't need like private investment. They do not trust. But I say that's all. Let's focus on mitigation projects. I think that at one side, we need to really continue urging the developed country parties provide the funding they pledged. At the same time, in view that we cannot wait. The view that in the coming years, I think that definitely U.S. will stop its funding. Europeans, other OECD countries, they will wait also, because they said they are not going to share with those US leftover. So I think that issue should be how we could encourage some of the OECD countries, other economies, to provide public funding, at the same time to leverage the private investment, go to this energy sector. I think this is one I should say combination we should do. One is the public funding providing plus this the leverage of the private investment. The other combination, I think, of course, whenever talking about the climate financing, people are thinking, okay, we need to have a fund. We need to have a pooling of the resources and funding. I think that also we need to change our mentality, because we combine pooling of the funding to some governments for their own investment. At the same time, I think there'll be more innovative ideas we need to develop to encouraging more and more parties, investors, for the joint projects, for the cooperative projects, to see that these investors is more trusting in their investment and more confident in their investment. I think so the investment should come with to more modalities. Third, I think now it's really a moment for all the country to rethink and reevaluate. We really need to combine the issue of energy transition as well as securing energy security, insurance and security for all countries. Because we are at the moment for all countries not for the implementing Paris Agreement for achieving carbon neutrality. At the same time, we are also in the process of implementing 2030 agenda. And SDG 7, international community, we are obligated to help all the human beings to have access to reliable, clean, and modern energy. As you know, because in my tenure in the UN as USG, looking after these issues, I think it'll be in 2017, there's around 100 million, about 1 billion people around the world. There's a lack of electricity. Now with our international efforts, this number reduced to 700 million, mainly in Africa. And some groups are still in South Asia. So in the next 20, 30 years, as we are going to continue to advancing this energy transition, we need to ensure that 700 million people, our fellow sisters and brothers, they are going to have access to electricity. I think that's be. So my fourth point, I think, to be for all countries, all investors, when you think of it. So energy transition doesn't mean we're just confined to the solar and the wind projects for generation. Energy transition means transition and a change of the entire supply system, like the generation of the electricity, transmission of the electricity. Even I think it'll be the recent accident happened in Spain and Portugal reminded the world that we are threatened by the insecurity of our network of electricity. So I think it'll be energy transition means that we need an entire system change for generation, for more clean energy, more renewable energy, as well as transmission change, as well as also mentality change for our consumers. Yeah. So that's why I think there's a long way to go.
Certainly a long way to go. We are a bit short on time in terms of where the session is going. Hopefully we can open it up to the panel soon. So we've diagnosed the problem, I think, quite well already. We have data transparency issues. We got to build up project expertise, cost structure for climate finance, perhaps a little bit too high in many of the developing economies as well. Let's talk about what works. Excellency Al Suwaidi, $6.5 billion committed right now in terms of climate projects around the world for Alterra. Give us some of the key lessons that you found in terms of this capital deployed, in terms of what works in terms of mobilizing green, the green transition.
Yeah. I'd like to remind everybody we're a fund that's only about 2 years old, so we're still learning what works well. But certainly we can very clearly say that we've been very successful off the bat, particularly because today we have about 90 gigawatts of power that we're invested in around the world within 2 years. We, at a fund level, believe that we can mobilize about 115 billion using just the 6.5 that we have. And with the two funds that we created, when we originally started, these were very key funds that we wanted to create with Brookfield and TPG. Brookfield does sort of infrastructure, TPG private equity, and then with BlackRock, we're developing other solutions around debt and other things. But with these two particular funds, we seeded them and we came with a very innovative model to catalyze other investors to come into the fund, because that's a key part of what we're doing, is how to mobilize. And we believe that being creative is going to be so important, because we know that what we've been doing so far hasn't really worked very well. But our two funds have been super successful. Actually, we brought all together our financial minds in the UAE to think about this. And what they came back with was that they said, the simpler it was, the better. And we had a lot of consultants, and the consultants were like, oh, maybe you'll get 1.5, 2 times your capital. And what we can say is today at a fund level, we have 4 times our capital, and they're continuing to raise. So we've far exceeded what we expected to achieve. And then now they're deploying that capital into the global south, and we feel very excited about that. And we hope that we use this model of a sort of first in, capped out, but it's a bit more complicated there. But the idea was that simple was better. And what we want to see is proliferation of more of these types of ideas and vehicles. I think His Excellency is 100% right. At a UNFCCC or a global level, there's a requirement by commitments made by developed countries to deploy capital, and they have a historic responsibility to do that. And if they meet that, we can then leverage that to mobilize the private sector to do more, particularly for the global south. But we can't wait for that. So we have to think of those innovative solutions that we can do today, because people are experiencing the effects of climate change today, and people are growing their energy systems today. The energy demand is growing today, so we need to deliver it today. And I think that this is the perfect moment to do that.
Let me follow up on that, Excellency Al Suwaidi, in terms of what specific mechanisms and incentives from an investment management perspective do you think are going to be the most important for mobilizing the green transition? So Ms. Nyembezi have mentioned a few, but is it going to be, is it regulatory policy commitment? One of the panelists said leadership was very important. Power purchase agreements, securitization. What is it that's most important in your mind?
Yeah, I think that unfortunately it's one of those spaces where the silver bullet doesn't work, right?
It's a mix.
It's a mix of all of those things. In every place, every jurisdiction, every region is going to be slightly different. You need to have the right policy environment in place. You need to have the willingness of the private sector or the maturity of that market to be able to receive the capital and deploy it at scale. And then you need to have the technology that suits that particular market. We in the UAE don't have hydropower, for instance. Although today we do, we have a dam, we just built it. But it's not the same as what you have here in China. But we do have solar power, and we have other ways of generating power. In other places, wind might be the right technology, and that requires a different policy environment and a different investment framework. And so it's really an issue that needs to be taken case by case, region by region, and sector by sector. And then, we've talked just about renewable energy, and His Excellency made the whole point. We have to think about the full value chain. We invest across 4 pillars. We invest clean energy, which includes nuclear, and we haven't talked about nuclear. That's the whole sector of itself. Industrial decarbonization. How are we improving industry? And by the way, that's good for industry itself. Climate technology, we've heard here from our colleague that that's so important, especially with AI. How can we achieve efficiency? And then sustainable living. How are we thinking about how we live and how we invest? And so I think that there's a lot of solutions out there. can I just bring one example? Today, in the developing world, all of us use cell phones. Even if you go to some of the most remote places, you can find people with cell phones. And a cell phone is a pretty high-tech piece of technology. And we've been able to have infiltration of cell phone technology into very rural areas. And how did we do that? Countries did that by putting in place the right policy environments and then allowing the private sector to provide the solution, and we were able to do that. If we can do it for cell phones, we can do it for renewable energy, we can do it for climate technology, we can do it for these other sectors. We were talking, I think you and I were talking about this yesterday. We think of the numbers as really big, right? We need about 2 trillion of investment annually, right? We looked this up because we talked about it. Do you know that we spend roughly about 2 trillion every year on alcohol and tobacco? If we could do that, then we can definitely do it for these types of initiatives, which, by the way, would probably be much better for our health.
Wow.
We know where he comes from when you talk about tobacco and alcohol. In my country, that wouldn't work. Can I just...
But that's great context, by the way. We spend that much on alcohol.
Yeah.
Okay.
Yeah, no, it is. Can I just add something to that? So if I go back again to the example I gave you of the renewable energy power production in South Africa, the thing that turned the dial was guarantees. So those renewable energy independent producers were guaranteed that tariff for the duration of their project. So if it was a 20-year project, they could have certainty at least of one thing. Without that, the business case wouldn't stack up. So that the guarantees from the public sector, unfortunately, it is always going to be the public sector, is absolutely critical. In the session we did this morning, we talked about first loss as an absolutely critical part of the stack. Irrespective of the project that you're putting on the table, somebody has got to be prepared to take the first loss. Hopefully they never take it, but we invest other people's money. It's depositors' money. We cannot just willy-nilly deploy it in anything that even has the sniff of high risk. So to have all of these investor types lined up in accordance with their risk appetite is critical to get these things off the ground. So your funds, for example, may not want to come in at the bleeding edge. We expect the public sector to do that, particularly if you're going to be talking about adaptation. We haven't found the formula for a business case for most of adaptation projects, which is why they're not being done. So if you're talking about resource efficiency, I get the benefit as the one who is doing the project, not the funder. This is why we won't fund it. So this is really something where the economic viability of every project does have to stand alone, but there is a common thread about fundability for the particular kind of investor. So we know that the credit enhancements work, for example, in some of these things. That's what DFIs are there for, presumably. We know the guarantees work. We know that insurance works where everything else fails. And I think there's a menu of options that people can pick, and banks are very good at advising you. By the way, we're very good at saying you need a bit of that and salt here and pepper there to put it all together to be a fundable project. But to pretend that the financial institutions are going to be able to solve this just because it's good for humanity, I don't think is workable.
Excellency, you wanted to follow up? How about Himanshu? Let me get your follow-up real quick, and then we'll get Excellency's follow-up. Yeah.
I want to talk about quickly the business case of climate adaptation, Ms. Nyembezi, as you mentioned. So this is a real case study. We had one of the big Fortune 500 seed companies come to us and say, like, hey, we are growing a lot of seeds in Spain, in Europe, and Spain is running out of water. So we are seeing a lot of volatility in our production in supply chain. So what should the future of our supply chain look like? And they are growing in Spain and then shipping those seeds all the way to Asia, South Asia, and Africa. So we basically said, like, through our AI models that, hey, because of climate change is a big risk, but also a big opportunity. We help them figure out these are the new upcoming locations where you can actually grow these seeds. And turns out there were a few locations in India, and we told them, like, you're shipping to the India market, why don't you grow in India? And they decided to invest $120 million in logistics and seed processing facility in India. So I took that to the government of India, right, and said, like, look, hey, is there a case to be made that India could be the next Netherlands in seed production, serving the South Asian market and the Africa market? And these changes are already happening. Have you ever heard of Canada growing strawberries? It's happening now. Have you ever heard of Kenya growing avocados and supplying to the rest of Asia? It's happening now, right? So there is that clear business case for adaptation. And it's interesting that the Prime Minister of India, it's not because of what we did, I think it's independently. In his mandate, he said, in the next 5 to 10 years, India has to become self-dependent on oil seeds. That's the first step. They're importing 70% of the oil seeds globally, but now can we move to the higher value oil seeds and help farmers grow those oil seeds, increase their incomes, because, quote unquote, climate might allow you to do so now, right? And that's the first step. The second step is, once you become self-dependent, can you actually export those oil seeds as well? So I think all three of you talked about how we can shift the narrative of adaptation into a food security, into an energy security or energy access narrative, or a geopolitical security narrative. Then we'll see some more funds getting unlocked, including from the government of India. They allocated $1.5 billion for this mandate to make India self-dependent on oil seeds.
I mean, I can see Kenya growing avocados, but it would be very surprising if I see Edmonton, for example, growing strawberries. But that's a story for another day. Excellency Al Suwaidi, you wanted to follow up.
I just wanted to mention real quick, and I think it's really interesting that, again, coming back to this point that investing in climate is investing in the future. So you're looking ahead and seeing how is the world going to change and how can we be part of that journey. Hopefully not too much adaptation, but more mitigation. One of the things we do once a year is we have what we call our Alterra dialogues, which is sort of where we bring together people from different aspects and try to address particular issues. And we had our first one last year, and it was very fruitful. But one of the key takeaways I had from that was that in a lot of cases, to this point about well, what's the key thing to mobilizing capital to the Global South, is that there's a perceived risk that's there that has to be overcome. And there's a lot of investors, certainly that we deal with, who are from New York or London or Paris, who would love to be investing in the Global South because they see the promise and they see the opportunity, but they don't know how to manage the risk or how to think about the risk. And I think that this is something that we, Alterra, as born of the Global South and in partnership with colleagues from South Africa or from China, from India, we can create those solutions that allow those entities to find ways to feel comfortable to invest in these places. We can't hold it against them. Often these institutions are managing pension money. They have fiduciary responsibility. They need to do a good job. You mentioned this. So let's create the avenues through which they can achieve their goals, make the returns that they need to do, while we can help the developing world to continue on its development journey.
Fantastic. Fantastic case studies. Let me open it to the floor. Right now we've got about 6 minutes. Raise your hand, state who you are, brief question. Is that Joel? Yes. Okay, Joel, over to you first.
Hi, Michael. Good morning, everyone. Fascinating. Joel Rouet, chairing a G20-endorsed think tank on climate finance. The question is for whoever in the panel on adaptation becoming a investable asset. What's the possible role for what's already working more or less, which is the green bonds, the blue bonds, but just beyond the way it happens now. The way it happens now is that you get a kind of a premium, you get a discount when public finance gets to refund itself. Can we peg that through programs? Can we peg that to real assets, to underlying factors? Can we use AI, blockchain, tokenization, new technologies for that? And not only for resilient agriculture, but also for resources regeneration, land regeneration, water regeneration. Very big, but your hints on that. Thanks.
Really pushing the innovative frontier there. Who wants to take a crack at that question?
I can start.
Okay.
I think I'll piggyback on the comment that Ms. Nyembezi made there. The power of financial innovation on actually pricing risk. It seems simple, but the data does not exist. So you're talking about the asset classes outside of agriculture, and even in agriculture, there's very limited understanding of how those asset classes are impacted, more so in the developing countries rather than developed countries. And the power of innovation is like in 1980s, we all remember when the Black-Scholes model came out for option pricing, that changed the financial industry altogether from $0 to now $400 billion in daily transactions in futures and options, right? So we can figure out a way to price the risk on these assets for investors. Then, of course, I feel that there'll be a lot more instruments that will be rolled out, and there'll be a lot more liquidity in the market.
Great. Another question. Yes, I saw this gentleman's hand first, in the first row.
Fascinating panel. Thank you for this great discussion there. I'm a supply chain data entrepreneur, and I have been seeing that most of the customers to whom we sell this solution they are getting they're focusing much more on risk management as well as compliance rather than on impact programs there, thanks to the current climate and the tariff focus. So maybe a commentary from you, because generally while you say that so much of investment is ready for climate and impact, we see that the business leaders are moving the dial more towards risk and compliance, and actually the priority on impact programs is getting lower and lower.
I'd be happy to jump in here. Look, the climate finance space is a nascent industry. And I think one of the big challenges is that, and we talked about this in the panel this morning, is that how do you measure that impact? And it's not always apples to apples. And for the finance industry that's trying to deploy capital at scale, or for many of these institutions who have fiduciary responsibilities in terms of their reporting, et cetera, it's very difficult. We at Alterra invest with a dual mandate: one, to make commercial returns, and two, to make impact. And our board is always asking us about this impact metric. And we measure impact from 2 points. One, from mobilization, how much every dollar of ours is mobilizing another dollar, and then from a climate impact space. But then when you look at that component, sector by sector, it's very different. And it can be very different in a developing world versus the developed, and so on and so forth. So it's just by nature relatively complex. However, I do believe that the more we work together as industry or sectors to standardize that, to create metrics, to create frameworks through which we view these, the better it will be for all of us, and the easier it will be for investors to compare oranges to oranges or apples to apples. But that is a weakness that we have today.
Great, thank you. There was another hand here. Yes, this gentleman here in the second row. The microphone is right behind you.
Thank you for the wonderful insights sharing. So I'm Dongjie Chen from Global Shaper Community, also the Youth Ambassador representative of UNESCO for COP29 last year. So my question is, youth-led organizations are often excluded from climate fund allocation process. So given that younger generation will play an important role in the future development of the whole human society, so could you give us some advice to younger generation for making more meaningful youth participants in climate finance governance? Thank you.
Who are you addressing the question to? Anyone that wants to answer.
Yeah.
Okay.
I think His Excellency would be good for this.
Which Excellency? Special Envoy Liu? Special Envoy Liu. Do you have any insights on that? How can we get the youth more involved on climate action?
I think it'd be used for the future. Definitely think it'd be actually, for climate financing, definitely I think we need to mobilize not only the financial sector support, but as well I think it'd be the support of the society. Actually, I think we need to convince even from financial sector, we need more engagement, more involvement of the youth to say that there's urgency. They need to realize urgency for the investment in energy transition, because I think the urgency is not just from the urgency of the threat of the climate change, but also if we waste the next 3 or 5 years, the overall cost of investment will be increased dramatically. I think this is, I think nobody have talked about this point. I want to really alert the financial sector and the investment community to be, now people are talking about, you see, the surplus, the overcapacity, overproduction. Actually, in China, we don't agree for that. But China's manufacturing has helped to maintain this low cost. As colleagues mentioned, now this solar wind equipment is much cheaper than the traditional energy investment.
Yeah.
I think, but of course, if we are not going to invest more in the coming 3 or 4 coming years, definitely, I think there will be dramatic change of this manufacturing.
Yeah.
Then, if we wait another 5 years, the cost of price will go up.
Special Envoy Liu, urgency, absolutely important because it's going to affect his generation, right? Excellency Al Suwaidi, you wanted to follow up real quick.
I can just talk about what we do in the UAE. We have a Minister of Youth in the UAE whose job is to ensure that young people are represented in government decision-making and others, and that's certainly what we do in the UAE. At COP28, if you remember, we created a youth representative as well. And so we believe strongly that youth bring a lot to the table. I know in my team we have a lot of young people. And the only thing I would say is that there's also a responsibility on youth to come forward with really good ideas. It's not just about being in the room and participating. It's about how are you contributing, how are you starting a business, how are you being an entrepreneur, how are you coming up with new ideas. So youth are not separate from society, they are us. Right, we're still young people on here on this panel. I like to think, right? And,
it's about mindset, right? You're young at heart. That's all that matters.
It's about what you're contributing, how you're making use of the opportunities that you have to come forward with really smart and bright ideas that'll help make a difference.
Yeah, and I would say, look, you have agency too. Feel free to start your own youth forum on climate action, right? You have that agency. Yeah. We're all out of time. Himanshu, you got to run to another panel. Thank you so much for all of our panelists and talking about such a timely topic. And I think there's no reason why climate-focused investments cannot earn the returns as some of the top performers in other asset classes that we see around the world. A quick shout out to Special Envoy Liu. I really wanted to ask you about the investment opportunities for private capital, private international capital in China's energy sector, because China has now opened up its energy industries, except for nuclear, to foreign investment. But I guess I'll ask you that in my interview with you on CGTN later in the day, so you're going to have to tune into CGTN to find out the green investment opportunities here in China afterwards. But a round of applause for our panelists, please. Thank you.